There's something happening in the gold market that I think most people are completely misreading. Gold has been climbing for 2 years straight, sitting near record highs above $4,000 an ounce. And the usual explanation you'll hear is inflation or fear, or people are worried about a crash. But that's not the real story. The real story is who is buying, because the biggest buyers of gold right now aren't nervous investors or doomsday preppers. They're central banks, the same institutions that print money, set interest rates, and manage the reserves of entire nations. In the first quarter of this year alone, central banks bought around 244 tons of gold. Think about how strange that is. The institutions whose entire job is to manage paper currency, the dollar, the euro, the yuan, are quietly stockpiling the one asset that exists specifically as an alternative to paper currency. That's not a fear trade. That's a strategic move. And by the end of this video, you're going to understand exactly what they know that most investors don't, and why it's one of the most important signals in global finance right now. Here's what I'm going to walk you through. First, why central banks are buying gold at this pace, and it's not the reason most people assume. Second, the specific event a few years ago that quietly changed the entire game and kicked this off. And third, what this tells you about where the global financial system might be heading, not as a prediction, but as a set of forces you can actually watch unfold. I'm Daniel Ayala. I manage a fund professionally every day. And a huge part of that job is exactly this, watching what the most sophisticated players in the market are doing with their own money and asking what they understand about the world that hasn't shown up in the headlines yet. Because the smart money usually moves before the story becomes obvious. Let's get into it. Let's start by clearing away the lazy explanation, because you'll hear it everywhere. The lazy version is gold goes up when people are scared, fear trade, inflation hedge. And sure, there's some truth to that. Gold does tend to attract nervous money, but that explanation completely falls apart when you look at the actual buyers. Individual investors, the nervous retail crowd, are actually a relatively small part of what's driving this. In fact, only around 10% of people own physical gold at all. The heavy, persistent, record-setting buying is coming from central banks and from a few specific governments. And central banks don't buy out of fear. They don't panic buy. They make deliberate, long-term strategic decisions about how to protect the wealth of an entire country over decades. So when you see central banks accumulating gold at roughly double the pace they did just a few years ago, they're scared. Doesn't cut it. The right question isn't what are they afraid of? It's what are they repositioning for? And that's a much more interesting question, because the answer points to something structural changing underneath the entire global money system. Here's the thing that actually kicked this off, and most people have no idea it's connected. A few years ago in 2022, something happened that quietly rewired how governments around the world think about their money. When the conflict in Ukraine began, the United States and its allies did something unprecedented. They froze Russia's central bank assets. Hundreds of billions of dollars that Russia held in dollars and euros essentially locked up and made unusable overnight. Now, whatever you think about the politics of that, and I'm not here to argue the politics, the financial message it sent to every other country on earth was enormous. The message was this: the dollar assets you hold offshore are not unconditionally yours. If you hold your national savings in dollars and you end up on the wrong side of the United States, those dollars can be switched off. For most of modern history, holding dollars was considered the safest thing a country could do. And in one move, that assumption cracked. So put yourself in the shoes of a country like China or India or any nation that wants to make sure its wealth can never be frozen by a foreign government. What do? You start moving your reserves out of dollars and into something that no other government can freeze, seize, or switch off. And there's really only one asset like that: gold. Physical gold sitting in your own vaults under your own control. Nobody can turn it off remotely. That is the engine underneath this entire gold story. Not fear, sovereignty. Countries protecting themselves from the possibility of being locked out of their own money. And you can see this playing out in the actual data if you know where to look. China is the clearest example. Chinese net imports of gold roughly tripled in the first quarter of this year compared to the quarter before. And China's central bank has been steadily ramping up its reported gold purchases month after month. Now, here's the part that tells you how serious this is. And a lot of central bank gold buying goes unreported. There's no rule forcing countries to disclose every purchase to international international bodies. So the official numbers, as big as they are, may actually understate what's really happening. Some of the biggest buyers are deliberately quiet about it because openly announcing we're dumping dollars for gold would move markets and create friction. The quietness is itself a signal. This is being done strategically, not loudly. And the why behind China specifically goes one layer deeper than just protection. China appears to be building gold reserves as part of a long-term project to eventually position its own currency, the yuan, as a genuine alternative to the dollar on the world stage. Gold is the foundation of credibility for that ambition. You can't ask the world to trust your currency as a dollar alternative if you're holding dollars as your backing. You back it with the one thing everyone agrees has value, gold. So this isn't a trade, it's the early scaffolding of a different global financial architecture. That's a very different thing than people are worried about inflation. And here's what I want to zoom out, because this is the actual skill I care about teaching. The lesson here isn't buy gold. The lesson is about reading the difference between a trade and a shift. A trade is short term. People buying because they're scared this month, selling when they calm down next week. That's noise. But a shift is structural. It's the largest, most patient players in the world slowly positioning or repositioning for a different future. And it unfolds over years, not weeks. And the two look completely different once you learn to tell them apart. Central banks buying gold isn't a bunch of people reacting to a headline. It's the most sophisticated institutions on earth quietly hedging against the possibility that the dollar-centered system they've relied on for 80 years might be slowly changing. When you see that kind of buyer moving that patiently in that size, you're not looking at a fear trade. You're looking at smart money preparing for a world that doesn't fully exist yet. And the entire edge in investing is learning to notice that before it becomes the obvious headline everyone's shouting about. That's the difference between watching the market and reading it. The headline says gold near record high. One layer down says the institutions that manage the world's money are quietly diversifying away from the dollar, and they've been doing it since a specific event in 2022. Same price, completely different meaning. Now, let me be straight with you. The way I always try to be. None of this means gold only goes up, and none of this is me telling you to run out and buy it. Gold is volatile. It can drop hundreds of dollars in a stretch, and it has. There are real forces that could push it down. If interest rates go up, gold often struggles because suddenly holding boring cash that pays interest looks more attractive than holding metal that pays nothing. If the geopolitical tensions ease, some of the fear premium comes out. And after a 2-year run, there's always the risk of people simply taking profits. All of that is real. So I'm not predicting the price. What I'm pointing at is the structural force underneath. The central bank buying, the de-dollarization, the sovereignty motive, because that force is likely to persist for years regardless of what the price does month to month. And that's what to actually watch. Watch whether central banks keep accumulating or start to slow. Watch whether more countries follow China's lead. Watch whether the quiet buying gets quieter or louder. Those are the signals that tell you whether this structural shift is accelerating or stalling. And they matter far more than any single day's price move. You don't need to predict where gold closes this year. You need to understand that the world's most powerful financial institutions are preparing for, and watch the evidence come in with a clear head, while everyone around you argues about whether gold is going to 5,000 or back to 3,000, missing the much bigger story underneath. If this way of looking at the market is useful to you, I write a free weekly note where I do exactly this. I take whatever's moving beneath the surface that week and break down what the smart money is actually doing and why. No hype, no doom, no price predictions, just the real forces underneath the headlines. The link is in the description. And here's the question I'll leave you with, the one I hold myself to every single week. What would tell me if I'm wrong? If central bank buying suddenly reversed, if countries started selling gold and moving back into dollars, I'd have to rethink this entire read. Knowing what would change your mind is the whole discipline, and it's what I try to practice out loud in that newsletter every week. Come think alongside me. If this helped you see the gold story more clearly than the headlines do, share it with someone who's only ever heard gold goes up when people are scared. There's a much deeper story here, and the more people who understand it, the better the conversation gets. I'm Daniel Ayala. Thanks for watching. I'll see you on the next one.